Hello and welcome to Ticker Tapes. It's Wednesday, which means it's time for a look at the crypto space. It's been another testing week for the cryptocurrency markets, with Bitcoin falling by almost 28% over the last 5 days, while Ethereum fell even further and was down by 33.9% over the last week. Most troubling of all, however, is the fact that most of that loss was racked up in one business day. Once again, the root cause of the problem for Ethereum can be traced back to the world of decentralized finance, or DeFi as it's known, and in particular to a lending platform known as Celsius, through which traders could stake or lend out their holdings in Ethereum to generate an income from the fees charged to borrowers. Celsius had reportedly offered yields of up to 20% on staked cryptocurrencies, which it loaned out via protocols such as Lido Finance, which in turn converted Ether into staked Ether tokens known as STETH, which were valued one-to-one with Ether. However, just as we saw with the collapse of the Terra Luna ecosystem a few weeks back, cracks began to appear as the price of Ether and other leading cryptocurrencies fell following last Friday's higher-than-expected U.S. inflation data. And with the markets in a risk-off mood thereafter, investors that had staked Ether via Celsius and Lido wanted their coins back. However, due to lack of liquidity, Celsius couldn't sell or redeem Lido's STETH tokens to enable the return of the staked Ether. Celsius tried to put a brave face on things over the weekend, but by Sunday evening, the business had paused and then halted all withdrawals from the platform. Celsius is believed to have had around $8 billion in assets and outstanding loans of some $12 billion. What happens next for the platform and its customers is unclear. There were also issues in withdrawing Bitcoin from the Binance exchange, which were attributed to several hardware failures within the exchange's crypto wallet infrastructure. A workaround took 3 hours to implement, and that delay didn't help investor sentiment. Financial markets operate because investors have confidence in the products they trade, and when and if that confidence evaporates, everyone heads to the exits at the same time, which is never a pretty sight. Despite the turmoil in the markets, developers continue to try to find new uses for crypto technology. One of the latest innovations to be suggested is a stablecoin linked to the price of electricity. Scientists from the Lawrence Livermore Laboratory have combined the theories of statistical mechanics and information theory to create a coin that would, in theory, allow the transmission of electricity without wires. Instead, the energy would be transferred as a form of information through the cloud, with the initial mining and subsequent burning of the coin inputting and then releasing the energy contained within it. For now, the idea remains a concept and is unlikely to come to fruition without a major leap in cloud computing capabilities. Nonetheless, it's an intriguing idea, and it showcases what smart contracts and cryptos could achieve in the future.